Just this past week, the yield curve inverted, and that could be a signal of a recession on the horizon. What does that mean for you? Which signals actually are signal and which are noise? In today's video, we're going to talk about some of the most common things that are pointed to as harbingers of recession, their legitimacy, and the bull and the bear case for here in 2022 in markets generally.
I'm Hannah, this is Erin, and you're watching the Piper Rundown. We analyze business and culture to help you win. Today's rundown is presented by JetStore. JetStore has been providing affordable, reliable, and easy to manage data storage and cloud solutions to over 4,000 customers worldwide for more than 26 years, which is longer than I have been on planet Earth. They know their stuff when it comes to data storage and cloud management solutions. There's quite literally no one better to help you with that. Check them out at jetstore.com.
Even before Hannah was but a twinkle in her parents' eye, financial prognosticators have said that the sky is falling. Alert, alert, warning, financial calamity is coming.
How joyful. What a joyful way to start out the video.
There are all sorts of charts and statistics and pieces of data that these pundits will use to support their case. And what we'd like to do in this video is go through a few of them and try to very simply explain and articulate the underlying argument that one makes when they use those statistics. We're going to touch briefly on their validity. We are not intensive market researchers, and it's important to recognize that if you don't have up to the minute, up to the second data of some of these sources, or actually are more capable of being anticipatory of what that data will be in the future before the competition, you are at a fundamental structural disadvantage in financial markets. Why many advisors will say, just index, just dollar cost average, don't try to time the market. But you clicked on this video because you have at least some degree of curiosity and perhaps some warranted concerns of a forthcoming crash that could, create a buying opportunity or eviscerate your portfolio. So the one that has caught headlines most recently is the inversion of the Treasury yield curve. Treasuries are the most liquid, deep market that is traded in all financial sectors. It is because that Treasuries are generally conceived to be one of, if not the safest and most secure assets that can be held in a portfolio. The yields of a government bond like this over a time horizon are represented as the yield curve. Okay. So traditionally, the yields for short-term duration assets are not going to be as high as those in the long term because the long term comes with more uncertainty than the short term. Sure. I feel like I can see 30, 60, 365 days out ahead of me much more clearly and securely than I can 30 years out into the future.
Makes sense.
When the yield curve inverts, what is occurring is a lot more buying of the longer maturity bonds out 20, 30 years in the future than in the shorter and medium term. Okay. What that signals is that more people have optimism over the long term than they do in the very short term itself. It's a signal that in the short term, I actually don't think that these bonds are going to do a lot for me, and I would rather stake my claim on something that has guarantees over a longer time horizon. Now, this is not to say it's a black and white needle moving. There's still some people who are buying those shorter term treasuries than the long term ones, but it is a signal of general pessimism about the short to medium term. And many financial prognosticators will say there's a correlation that when this occurs, in the next 12 to 18 months after, recessions occur. Now, that tends to be true. There is certainly a correlation there. We cannot necessarily say causation, but you're left with some relatively imprecise information. Recessions tend to occur about a year or so after this inversion happens. Okay. So what do you do? Do you just run to cash because eventually there's going to be a recession and then I'll jump back in? Maybe. But that presumes a whole bunch of timing. And married to that is another thing that people point to is the generalized trouble around geopolitical conflict. So in past geopolitical conflicts over the last 80 years, be it the bombing of Pearl Harbor, be it the crisis in Kuwait, Operation Desert Storm, we go on and on down the list, there are these severe drops as markets panic, the presumption of supply chains and economic disruptions, generalized lowering consumer sentiment. You're less likely to go buy the new car when things feel unshaky and uneasy. And then there are eventual reversions, as there have been for the last 80 years, when people start to get a lay of the land, understand that it's not World War III, that it's not the end is nigh, end of all things, and people continue to try to make their own economic progress. And so what makes this very difficult, and the reason that you cannot just buy into the overall hype of the folks that are selling gold or just blindly selling Bitcoin as the only solution to the imminent demise of all markets, is that there is enormous variance in the severity of the crash and the time that it takes to recover. So I know we usually do the numbies section, Hannah. I only have a couple numbies to show you. The bottoms for different geopolitical conflicts over the last 80 years, it can take 5 days or as many as 140 days, and I'm pointing to the Russia-Ukraine crisis in this instance, for the bottom to be set in. So sometimes it's sharp, steep, or it's quick, and then the bottom's been hit and upwards from there. The recovery can take anywhere from 4 to 300 days. And it is not always a factor of the significance of the geopolitical conflict. Sometimes a geopolitical conflict is anticipated, or at least to some degree priced in by the market. And so when it occurs, it is not the most severe drop because there's kind of been inklings that this can be happening. One could argue that the Russia-Ukraine conflict was preceded by the amassing of more than 100,000 troops on the Ukrainian border that leads plenty of geopolitical speculators to say, I think there's trouble on the horizon. On the flip side, there are all sorts of folks that could be underestimating the severity of the crisis, its capacity to extend into other domains, to have a cascading domino effect. If you have a distinct, concrete opinion on what that outcome will be, number one, that's somewhat myopic unless you have some sort of really special insider information. Even, some of the top prognosticators don't have an answer to that. But you have to be very certain of that in order to place your bets accordingly. Hey, the bottom's in, it's time to ride.
Gotcha. That makes sense.
So both of those are signals of potential recession. We don't know the severity. We don't know the timing of it. Then we point to concerns about rising oil prices. And there's actually a fair amount of studies that Chamath said this on a recent All In podcast. When oil prices go up, recessions occur almost always. There's actually a fair amount of data to disagree with that, and we'll throw it up on the screen here, that sometimes oil prices do not coincide with recessions, are not strong harbingers of recessions, because on one side, you have folks dedicating more of their personal budgets to filling up at the pump or embedded transportation costs in the foods that they buy. On the flip side, the oil and gas industry is one of the largest sectors of the entire economy. And when oil and gas prices rise, the ability to open more wells, initiate more projects climbs. There are certain projects that are only viable when oil's above $50 a barrel. There are certain natural gas projects that are only viable when natural gas in the US is above $4. It's up at, I believe, like $6 right now. So that initiates all these projects. Those companies need to hire. Those are good paying jobs. They're then in their community spending money and stimulating the local economies where those wells are occurring. And it's a much more complex picture than everyone can't afford as much because of the high gas prices, and so therefore the economy will tank. So that's why it's certainly some correlation, not a lot of causation. And then finally, we have low unemployment numbers. So another argument that will be pointed to about the potentiality of a forthcoming recession is unemployment is at lows, relative lows of the past 5 years, relative lows of the past 10 years. And there is, if you look at the chart, correlation between low unemployment preceding recessions. And if you kind of flip that around, the actual thing that is a causation is once a recession occurs, when stock markets tank, is the time when layoffs tend to occur. So you can be very certain that after a recession has been initiated, there will be layoffs.
Right.
But that is not necessarily a counter investable trend. Unemployment is low, and so therefore it makes a lot of sense to place a big bet on a recession occurring, because sometimes, as you can see from the chart here, particularly around the 2008 crisis, it was low unemployment for a while before the crash occurred. So certainly if employment is really, really low for a really, really long time, then there's a little bit of a potentiality to revert to the mean, but you don't know what low is. If you look over the last 30 years, some of the recessions came in when unemployment was at 6%. Some of them came in at 5%, also 4%, also 3%. And we now have a central bank policy, we have a monetary fiscal policy highly oriented towards maintaining low rates of unemployment. It is the explicit policy goal of those regulators. And so we lose a little bit of the signal, if there even was signal, in the noise of that number because of the fact that it is an explicit policy goal and therefore a manipulated indicator of the overall health of the economy when we see record low unemployment or unemployment returns to lows not seen in X amount of months, years, whatever. Becomes exceptionally hard to delineate the truth and what is actually being signaled versus a backwards looking report that tells us where we were, not where we're going.
Man, do you get torqued for charts.
I get so torqued for charts. I need that as a shirt.
Yeah, torqued for charts. All right, so this is not our typical rundown. So we don't necessarily have a comps, or I guess we could do comps section. You mentioned that.
We did a little bit of comps, but you can look at these other recessions and you can often find like 3 of the 4 things occurred. 2 of the 5 factors were indicated, but you have to be really careful. There's a famous quote. There's 3 types of lies: lies, damned lies, and statistics. More often than not, when someone's throwing numbers in front of you and trying to sell a specific narrative to you, they are cherry picking the data that supports them. I've looked at all the different investment decks, Morgan Stanley, BlackRock, all these characters. Yes, they're trying to provide signal through the noise. They want their clients to think, man, I've got the smartest bankers working for me and therefore I'm comfortable investing with them. But they also have the incentive to keep you invested.
You get another brilliant idea, a special idea, another situation, another stock.
That is the incentive of those financial advisors and those type of characters. And then you got the complete opposite incentive of the folks that are selling gold, that have a gold ETF, that have some sort of product that is predicated on people having a bearish outlook. They're going to cherry pick all the data that says the end is nigh. Prepare yourselves.
Totally.
Overall, we land somewhere in the middle.
All right, before we move on to the final part of the rundown, the bull and the bear case, let's hear about our sponsor, JetStore, one final time. JetStore offers storage systems for private cloud hosting, video surveillance, Internet of Things, AI, machine learning, edge computing, data archiving, HPC, media production, medical imaging, and even flight simulations. They can help you with all of your data storage and cloud management needs. Check them out at jetstore.com. On to the bull and the bear case.
For me, the bull case is very highly predicated on US equities in particular. But in general, North America is going to be significantly insulated from the geopolitical conflict and turmoil wrought by not only the Ukrainian-Russian crisis in the sense of the sanctions that were issued, but also the decimated wheat output that is going to drastically affect markets like Egypt and other more food insecure nations. As Americans, we are insanely privileged to have the Great Plains, the best agricultural plot of land on the planet, in addition to enormous moats in the form of the Pacific and Atlantic Ocean that insulate North America from these other parts of the world with all sorts of histories of conflict and trouble, particularly Europe. And so if you were highly invested in US equities, they've had a rough quarter. They've had a rough, I guess, like 5 months here now, that would kind of suggest perhaps the bottom is in, but we don't necessarily know. But over a long time horizon, I would much prefer to be invested in US equities and see the potentiality of their ability to benefit from overall instability and volatility elsewhere. If, Russians' oil reserves are cut off from being shared with the rest of the world, then all of the frackers and liquid natural gas folks around the United States and the oil men in Texas, they're going to have a pretty good time. The farmers in America are going to see enormous demand for their soybeans, for their wheat, for their corn. And from a technological standpoint, there is nothing impeding the US from having dominance in the Western world as those other characters continue to cut off. On the bear side, we did the interview with Doomberg. There's going to be food shortages. It is going to be a nuisance to people who are, highly wealthy in the developed world. It is going to be a matter of life and death for folks in significantly less privileged positions. And that volatility has the capacity to domino through our interconnected globalized world in ways that we cannot yet anticipate. And that really is always part of the pitch of the folks that sell the bear case, that sell, the sky is falling. But it is also the reality of some of the things that are occurring on the ground. So you got to stay vigilant. You got to continue to look at charts if you're a torqued chart looker like me. And in general, do take the steps to make yourself more anti-fragile in the short term. If you're some person managing a multi-billion-dollar portfolio, that means a completely different thing. And you got there by having risk management models that are battle tested for all sorts of fluctuations to interest rates and geopolitical conflict. If you are just a regular person, a retail investor, trying to figure out how to surf the wave and you're trying to figure out how not to get washed out by the riptide, it tends to mean really simple things. Building an emergency fund, having some general cash in the bank, reducing your overall debt burden. That's one of those things that is never, ever the type of thing you look back on in the past and have major, major regrets about.
Right.
You reduce, if you got credit card debt, pay that the F down now so that you have more options as time goes by. But trying to kind of thread the needle and completely, turn an out into a grand slam by taking on a ton of risk at any time is foolish, but particularly when some of these signals are up, is the time to make sure that you are in a posture that is resilient and anti-fragile and not poised for trouble.
Fair enough. That's a rundown. A little bit of a different one today, but thanks for watching. If you found this helpful or useful, make sure you hit subscribe, click the bell for notifications so you don't miss a single upcoming video. Got a lot of good stuff coming down the pipe. See you in the next one.